Thank you, everybody. So the next conversation is going to be about the cash leg dilemma, stablecoins versus central bank money. So I'm going to welcome our panelists onto the stage, if you don't mind coming up. The panel will be moderated by Anne-Sophie Cissé, who is General Counsel at Kaiko. Welcome on stage. Then we have Isabelle Delorme. She's the Global Head of Product Strategy and Innovation at Euroclear. Isabelle joined Euroclear in April 2019 as Chief Business Officer of ISES and sponsor of the Strategy, Product Development, Innovation, and Commercial divisions. We have Michael Winnicke from the DTCC, Managing Director. He oversees the strategic planning across the CSS business and industry engagements. Pierre Davout, Head of Euronext Securities and member of the Executive Committee, and John Ho, Global Head of Legal Financial Markets for Standard Chartered Bank. Thank you so much for being here, and I stole someone's mic.
Good afternoon, everyone. So today we are talking about the cash leg dilemma. So what do we pay in when we talk about tokenization in tokenized securities market? So we have a lot of activity. It's a very hot topic. Everyone is discussing about it. We have the Pontes launch, which should happen in September. DTCC is working a lot on this topic. Standard Chartered, through its affiliates, has launched also a stablecoin initiative in Hong Kong. So now we can say it's path theory. For the last few years, we were asking ourselves, are we really doing it? Now it's not a question. We are all there. We are all doing something. We are all building. So now the question is, what are we really building on it? Isabelle, Euroclear and Banque de France are launching Pythagore. Maybe you can give a few words about this initiative. And why would you choose CBDC rather than stablecoins?
Thank you, Anne-Sophie, and thanks for having me at the conference. A few words about Pythagore, because the name doesn't sound as self-explanatory. Pythagore is a joint initiative between Euroclear and Banque de France and all market participants around the modernization of a specific market, what we call in French the NECP market, meaning the short-term commercial paper. And the modernization is relying on the fact that we move everything on DLT with a settlement against CBDC. So even before I talk about the initiative, why CBDC? Because today the short-term paper are settled against not CBDC, but central bank money, traditional central bank money. So it's a continued settlement in central bank money indeed. But why do we feel it's very important? Because this modernization, which I said was all on DLT, is the first time, it's very unique, the first time an entire market will move its practice on-chain. And that's a key moment in time for the industry, even though it's one market, one jurisdiction. It's a key moment in time for the industry because it means that the entire ecosystem will have to organize itself, question its ways of working, indeed onboard all participants to make sure that at a moment in time, a borrower in a short-term paper cannot do it elsewhere. It's going to be only digital when it's all transition. So very important moment with key benefits in terms of the product itself. Maybe important to say for those in the room who know the market, it's not reputed inefficient. This is an efficient market, but with the migration on DLT, we can probably, or we can for sure, imagine a migration with less reconciliations, with an automatic dissemination of the ISIN code, allowing us all to think that instead of, for the borrower, the issuer, getting the money end of day or the day after, you can get the money after 1 hour. Now, getting to know whether the investor will want to pay in 1 hour instead of the day after, that's another question. But in the key benefits of the initiative, proposing to get this money much faster for the borrower is an important thing. And I think I answered already on the CBDC. I think it's a continued practice and philosophy around settling short-term paper, CPs, in CBDC. And we will come back to that, I'm sure.
And this is interesting also because DTCC, while you do not really have a choice in the US, you still have no CBDC. It doesn't appear that we have one so soon. So how do you handle it? Would you prefer actually to have CBDCs, or is it okay to do it with stablecoin? I know that you have some also cash, digital cash initiatives ongoing. So what is your point of view on this question?
Sure. So maybe be helpful just to kind of level set on where we are with our tokenization initiative. So, we're kind of moving forward in stages with the market, and really what we're delivering in 2026 in terms of the ability to create new efficiency and innovation in markets is a tokenization offering where our clients can convert their traditional assets at DTC into tokenized form. And then once they're in tokenized form, our clients can use those in on-chain ecosystems through a variety of different trading and financing applications that involve interaction with a stablecoin, a bank deposit token, really the currency and digital form of currency of our client's choice, right? So even though DTC itself is not, say, taking to the market a specific digital cash form where we are orchestrating the settlement, because we are creating a platform where our clients can move their assets on chain and where we can continue to maintain good control and record keeping the core responsibilities we have as a depository, it really allows our clients and the market itself to compete and innovate and kind of aggregate liquidity around different both trading use cases but different digital cash legs of their choosing. Now, as we look forward, that's certainly not the end state, right, for what we'd like to deliver to the market. We would like to deliver settlement orchestration tools. We would like to think about netting applications that are on chain where you would have to make some choices about, the currency pairs, essentially, that you're supporting for those netting functions. The taking in, potentially, of tokenized forms of cash as collateral. Very different use cases where we would then be coming forward to the market with, different options around the forms of digital cash that make the most sense for us, and where that form of digital cash is something like a dividend distribution, where it's maybe more of an election of our clients in terms of what form they'd like to take, what options we could offer our clients. So it's an area where we're doing a lot of thinking, but we didn't want digital cash to hold back the ability for our clients to use their assets on chain with different forms of digital cash through third-party applications.
Thank you. John, you are in the middle of the two worlds, I would say, both in the stablecoin activity and with CBDC, I guess, same as Standard Chartered, you will have, you probably explore this. So what is your point of view on this question? Do you think that there is a choice to make, or can we live in a world where we have both?
Yeah, I think the way to look at it is, it's not a question of, do I choose a standard traditional payment rails, or do I then move to complete DLT? I think the world we want to be in is a world where both traditional payments, or in the context of Europe, Target 2, and also DLT payment coexist side by side. I think that is the key towards that, because both have different use cases. And if you look at right now, where it looks at large value payments, you still rely on payment rails because it provides scale, it provides certainty given the settlement finality directive that's very clear, and legal certainty that you know that your payment is made and is irrevocable. If you move towards the DLT payment at this page, right, there's this still issue depending on which DLT system you use, what is it? Do you have settlement finality? Do you have certainty? And also, right, that not all DLT now talk to each other in a form of, there are still frictions, whether frictions in standards, messaging standards, frictions in that. So the world will evolve and converge to the point where if the standards are harmonized, I think there are a lot of working groups achieving that, then you can move between an on-chain and off-chain. Where we want to be as an institution is being a bridge towards the traditional world and the digital world, because these two can and will coexist. So it's not a question of if one or the other. The way we look at it is, how do we make sure we harness the best of both worlds and move forward towards that? So one idea, if you look at ISO 222 payment, where in November we migrated to the new standards, if you look at the meta payments for blockchain payment, it's still not there, right? There's still gaps. And how do we ensure that? So there's a working group to build that standards into the DLT payment. And until and unless that standards are harmonized, you still will have frictions. And I think we're all collectively working towards, together with all of you in the audience, how do we address those frictions to enable the world where we will have on-chain and off-chain sort of assets coexist.
That's, yeah, we can say that the how is very interesting, and this is exactly where we should ask the question. If we take Pierre at Euronext, so when you have the systems where a lot of clients rely on, what would be the trade-off that you are navigating between the capital efficiency the participants are used to, the systems are built on this capital efficiency, and the promise of eliminating settlement risk. So how are the clients reacting? Are they excited? Are they seeing a lot of risks that they can't manage today? What's happening on your side?
Thank you so much for having me today. I think to take a step back, right? If we look at the most liquid market in the world, like equities, govies, treasuries, big chunk of these markets are cleared before they are settled. And clearing houses, they provide two major benefits for the market. One, they neutralize counterparty risk. You don't have to care who is your counterpart because you know your counterpart will be the CCP. And that's very important. That's very important, even in a setup where you settle very fast. Of course, the risk element goes down with the period of risk, but being able to trade with whoever in the market and not being able to care or not having to care about who you trade with is a very important function. But then the second function is the netting that you mentioned. Netting exposures. I think this is a hugely efficient way to save capital in particular for the banks who are very active in these very large and liquid markets. And by netting exposures, you reduce the amount of risk in the market, therefore you reduce the capital. But by netting exposures, you can also significantly reduce the number of settlements in the market. And typically in equities market, a CCP will net down like 90% of the trades. So it's hugely efficient. And of course, today you clear and then you settle end of day or the day after, and you may argue, okay, let's move to atomic settlement. But even if you do that, you can design the market in a way that you do batches, like every 15 minutes, you net trades and then you settle them. So I think there are many ways to protect this fundamental function of a CCP, which is to net trade, net exposures to reduce the amount of settlement to be executed on a given day, whilst using the new rails that provide faster settlement, more efficient settlement. And I think we really need to try to combine both worlds. Because if you move into atomic settlement in these hugely liquid markets without any netting, the amount of cash you will need in a market to settle the activity will be huge and will by far exceed what's available on the market. Therefore, I believe that the type of models we need to design collectively are models where you have this capability of doing instant settlement using the new rails in coexistence for some time with the old rails because we need to transition clients from the old world to the new world. And you keep the fundamental feature of netting, which is hugely efficient in terms of capital and risk management.
Thank you. Actually, you are all leading innovation. And I guess that when you were designing Pythagore, for instance, with Pontes, netting was one of the questions. Is it already included in the structuration of Pontes? Is it something that you had to think about? One of the questions is, do we ask participants to bring more liquidity for the market to be able to exist? Or have we found a way to deal with this?
Yes and no. It's a no. Pontes and Pythagore does not anticipate netting. So netting is not managed in this phase. And at the same time, it's a yes because we are comfortable, we can manage the volume in a starting phase without netting, meaning that contrary to an equity market in Europe or a large bond market, the liquidity requirements for a transaction in CPs is not that huge and is manageable for the market. But that said, I want to insist, I think getting to a netting or satisfactory netting mechanism on DLT is key for the reasons explained by Pierre, but it's very important to mention how huge it's going to be if we don't. So I think there are several mechanisms that can simulate netting on chain. Will it be sufficient, or will we see the emergence of digital clearing houses? And at the conference, we have a very inspiring representative of that world. I think what will we be as an industry come as the best solution? At least I don't know. I don't know for my colleagues here. But solving netting is critical to the industry because it's not manageable at all, even for the biggest players, to pre-fund or fund instantaneously the money for this level of transaction if we don't have this net transaction at the end of the day.
Definitely, yeah.
Oh, yeah, just to fully agree, you know, and I think that is one of the reasons we're looking into, well, what is the core value proposition of a CCP? It is that capital efficiency, right, that we're able to create for markets. I think our netting levels are around, you know, average around 98, 99%. And so, you know, trillions of assets with billions of actual settlements. But when we think about, that's not to say that markets shouldn't move on chain, though, and that you shouldn't find a way to deliver netting efficiency on chain. Or thinking about the alternatives may be, what do lending markets look like that are much shorter in duration, much more 24/7, to be able to fund large intraday debits that firms would have if they're doing more real-time gross settlement. Very large, but potentially short, right? And what is the capacity of the market over time to support that from a lending perspective? And what would the role of entities like FMIs be in facilitating, right, those types of markets in a hyper-efficient way? Like the risk is either moving from, you know, CCPs netting and guaranteeing trades to saying, okay, maybe that risk moves into a lending market that then still maintain some amount of counterparty risk and fire sale risk and a liquidation. And so then how do we service those markets? So it could be different ways of getting to the same outcomes, but where I still think there's a strong role for FMIs to play to create that sort of capital efficiency and risk management.
Dare I say that in this particular situation, having CBDC in production is very important.
We'll be waiting for a while, the US.
Yeah, just to interject to the conversation, right? If you look at the number of tokenized securities or bonds issued in Europe since 2021, this statistic was issued just last week by Piero Cipollone, which is an ECB member on the BIS website. It's €4 billion. Now, to your point, how many digital CBDCs are issued in Europe? None. So we can talk a lot about how do I grow a tokenized market, but if you don't have an on-chain settlement, you have frictions, right? So I think the way to look at it is obviously wholesale CBD do have a role. We do participate in wholesale CBDC in our ecosystem, but at the same time, we also need an alternative, reliable, regulated settlement assets, which in the context of you know, if you look at MICA, we have what we call the regulated EMT, e-money tokens, or asset reference tokens in Europe. That market is still very small. It's not even close to $1 billion. So you got 4 billion worth of assets, but less than 1 billion worth of settlement assets. How do you operate? So in order for this market to scale, we need the asset settlement leg, because otherwise, you will have frictions in your settlement, especially when you move cross-border. So therefore, if you're looking at it, this market, in order to grow, to your point, you need obviously netting, you need certainty and FMI involvement, but at the same time, we need people in your audience to look at how do I scale this? Obviously, how do I create more the cash leg? Because we're on this topic about cash dilemma. The dilemma here, lots of interest in tokenization, of many things on the assets. But what's the alternative in an online payment mechanism? That needs to be addressed.
if I may, I believe things go in the right direction because in Europe, like a few months ago, the policymakers, the Commission proposed what they call market infrastructure package, which is a whole set of measures to foster the development of European capital markets. And one of the measures is precisely to allow CSDs to use EMTs, so MiCA-regulated stablecoins, as a settlement asset. And I think this is a fundamental measure because it will embed into the regulatory framework the ability for settlement systems to use stablecoins as a settlement asset.
And to inform the audience, it's going to be somewhere between 28 and 30. So it's not that far away.
Something when I'm coming also from traditional finance, more on the trading side rather than on the infrastructure side. But in startups, we kind of see what we think is inefficiencies. And we think, okay, this is something I need to find a solution to, and the market will come to it. However, if we take IOSCO, they published a study they did, which shows that when we give market participants the option to opt for the T+2 or to have an atomic settlement, they prefer the traditional way a lot of time. So this is one question actually for you, John. Is it surprising that people still prefer this T+2 when well, in our opinion, in blockchain, we could be more efficient, faster? What do you think?
Yeah, I think the building blocks to enable institutional netting and legal certainty is still missing blocks. What I mean by that is if you look at for the global treasurers and asset managers, if you're using RTGS system, target system, you can net, right? You can net your payments, you have legal certainty built into the system. But if you're moving on to the current blockchain payment, that legal certainty standardization is still missing. But what I'm saying is what you're seeing now should not mean that, look, it will not scale because as we speak, things are being developed in a sense of to enable the sort of same regulations to apply in a sort of blockchain-enabled world. So in the world where money moves at scale and you have legal certainty, that is where you'll see a huge shift to tokenization. Now, we're not living in the question of future. It's now. Now, if you look at example, 4th of July, 2025, that's the Independence Day in the US. Large value payments across Asia Pacific all the way to Europe. They cannot make large value payment. You can make very small payment, but you can't make large value payment cross border. We move large value payment on a regulated stablecoin on that day alone is because institutional players, large payment companies, large players wants to make payments, wants to move payments at scale. Now, that addresses there's a need to do this in an institutional manner. Now, we talk a lot in Europe about, look, we need to have a euro-denominated ecosystem because otherwise it's going to be largely dollarized. And I think we should encourage alternative regulated payment sort of mechanism in this Euro time zone that allows for tokenization, that allows for cross-border payments, and allow for commerce to operate on 24/7. So the question now is also not just about if good to have, because until and unless, especially Europe, they want to make euro as a reserve currency, you need to move on-chain because the world is moving towards a digital ecosystem.
I was actually in Japan a few weeks ago, and I remember the regulators were discussing together, and in the end, the conclusion was, okay, we need to build our own payment system on the blockchain because we can't just wait for innovation to build on the dollar. it's not possible and not doable. So how can we handle it on our side? Which brings me actually to a question about interoperability between the different systems. I know at Euronext it's a big topic. So do you think that tokenization is the solution to the CSD interoperability question?
So the short answer is long-term yes, short-term no. Now to elaborate a bit. So first, why is interoperability so important? It's so important because settlement systems exhibit network effects. I mean, that's obvious, but they exhibit very strong network effects. So the closest you are to universal reach, i.e. the closer you are to a situation where you can settle with anyone on the planet without any friction, the better, and the more value the settlement system will have. So when you have strong network effects and the need for universal reach, you have two solutions for the model to work. Solution A is to have a monopoly. You have a monopoly, one, and then everyone's connected to that. This has been the traditional approach for, let's say, fixed line telecom networks. You had one per country. Monopolies have drawbacks, but that's one solution. The other solution is to have competition, but the competing networks need to be interoperable. This is typically what we have with mobile networks, right? If you are a client of Vodafone, you can call anyone outside of the Vodafone network, provided there is this interoperability. So that's why interoperability is so important. We are all building our own systems. There are different regions in the world, so having a global monopoly will not happen. Therefore, we don't have any other choice than to find a good solution where you have competing systems which interoperate. Now, what's the benchmark? If you look at Europe, where we had a concrete problem to solve, which was we have 30 CSDs already, right? 30 settlement systems, 30 chains. There is a solution to that problem, which is called the target to securities. And Isabelle and myself and others, we share the same settlement platform. Therefore, a client of Euroclear can settle with a client of Euronext without any friction. So that's for me is the benchmark. So when we think about development of tokenization and interoperability, short term for sure there will be more fragmentation, and that's fine because that's the nature of innovation. But when we design the system long term and when we want it to move mass markets, large markets into it, we need to establish an interoperability level which is as frictionless as the one we've put in place with, for instance, target to securities.
Can I echo to this comment, because I necessarily agree with Pierre, but I would like to make it more global. And because Michael and I are in the same panel, I think important to promote a little bit the work that we have done on interoperability. The name won't speak for you, but the ACP, these digital asset control principles, are meant to communicate with the entire industry, but really even beyond Europe, that, Clearstream, DTCC, and Euroclear have been working together on principles to ensure ultimate interoperability across networks. So indeed, in Europe, we have a minimum viable setup around the ECB. It's very important to ensure that in Europe, but I think it goes even beyond, globally speaking, across continents. And this document is public. You can download it from our respective websites.
And I think there's sort of the aspiration of where we could get to eventually with total global interoperability, but still very practical things that can be done in the short run around common data standards, roles and responsibilities across the life cycle of assets, where that alignment is a building block for even, kind of an end state of much more seamless, frictionless interoperability where, yes, there may be different assets and different that are issued, different forms of digital cash, et cetera, but they could migrate more easily across different environments, right, without friction. But, and getting to an end state where a client of DTC with a registered wallet can hold, any asset issued by any depository, like there's still quite a bit of legwork to do to get to kind of that more utopian end state.
Jan, can you help us, walk us through the process actually? If I use the stablecoin you will hopefully soon have, and you want to have a counterparty which is based on Pontes, what should happen for it to happen? I guess we still need to build some of the steps. So can you walk us through it?
Yeah, I think conceptually, if you look at a cross-border sort of payment, one is you need to make sure you connect within the Pontes ecosystem, as well as enable the sort of blockchain, especially the euro, the Hong Kong dollar euro to be done. Now, if you look at in the world where right after Genius Act last year, there's a lot of pent-up interest around the world in terms of creating a legal framework for regulated stablecoin. And one of the things that need to work is clear regulation that what is it is a stablecoin? Is it a crypto? Is it a payment token? Or is it e-money? That needs to be established. One of the things, it's not about the technology alone. It's about the classification of the stablecoin, because you can't have one aspect of one stablecoin moving from a payment to a crypto and to something else, right? It has to be, to your point, interoperability is not just about messaging standards. It's also about ensuring the legal treatment of that particular asset class is consistent throughout the ecosystem. Otherwise, there's frictions, and you can't call it something else. Now, if it's payment, the question is, how do I embed the ISO 222 in the ears? Because it's not about technology. I often hear a lot of blockchain people say, look, my blockchain, 1 billion TPS per minute, why can't you use my blockchain? And I asked them, do you understand what ISO 222 is? They draw a blank. That is the core messaging standards for traditional payment right now. Now, how do I bring that standard to blockchain payment? Because you need to have travel rule to make sure the data is embedded, and that's what, as we just talked about, is being built within the ecosystem, right? So to your point, how do I enable cross-border payment? We, obviously, in the absence of the current thing, we are enabling peer-to-peer exchange, for example, or on the context where we're working cross-border, we will embed that working with a number of organizations like here, SWIFT as a working group right now, to build those standards into the DLT ecosystem. Now, the day will come that the standards applied in the traditional payment and the blockchain payments are equally similar or the same. That is when your payment will arrive almost real-time or instantaneously, that you don't even know the difference whether you actually use a blockchain or a payment system. So, to me, to your point, it's a great question, but in order to happen, regulations, interoperability, ensuring the ecosystem treats the same asset class the same, these are core building blocks that need to happen before we realize the full fruits of a cross-border sort of asset transfer.
So rather than asking the question CBDC against stablecoin, maybe we should ask the question stablecoin against stablecoins to begin with. What do you think, Michael? Do you think it's a relevant question? Do you deal with any stablecoin in the same way? Should we make a difference in terms of tokenization? Obviously, the payment, the cash leg will have a big impact. So what are your thoughts?
So, I mean, I think one of the benefits of the way that the U.S. is approaching digital cash, right, is that we have a very competitive ecosystem. Well, there'll be many forms of stablecoin, bank deposit tokens. You know, Finality has a solution that integrates pretty tightly with our central bank kind of ecosystem. But one of the downsides is that, yes, you have fragmentation, right? And the reality is that I don't think that an FMI is in the place to say we can treat all of these different instruments as fungible with each other, because they will have different risk and liquidity profiles in terms of the level of adoption, the amount of cost embedded, the processes around and timelines around, you know, kind of redeeming out for cash, so I think there might be more roles for like banks, right, to think about, who are really good at risk transformation, right, to take on more of a role of like, how do I have a trading business where I'm able to allow people to, at a low cost, exchange one form of risk for another. I think as FMIs, right, we will, you know, look at where is it a client-driven choice, right? So if an issuer is paying a dividend in cash, and we want to allow that distribution to occur on-chain, and potentially in the form of a stablecoin, maybe that would be at our client's election, and we'd be able to support a couple of stablecoins. There'd have to be a business case, the economics would have to be there. But if we're thinking about, you know, are we going to take in stablecoin as a form of margin, right? That really has to be driven by a CCP risk consideration, and where we'd have to look at the ability to, you know, exchange that for cash, you know, in repo markets, the ability how quickly you could redeem out. And so I do think you would have different classification of different stablecoins or forms of digital cash based off of their different risk and liquidity profiles. And then from a markets perspective, we're all talking about netting. And so what do CCPs on chain support, right, in terms of netting, and how many different currency pairs? And that, to a certain extent, I think will be driven by CCPs, but really by the markets in terms of where's the liquidity emerging. And, you know, day one, we're all taking tokenization forward. We think the volumes on day one maybe don't dictate, you know, that you have netting immediately, but you'll see sort of where liquidity aggregates, and that's probably where the netting will be needed, is around that currency pair.
So I guess we already have one of the answers to my next question. John and Pierre, what do you think about this fact we have many settlement instruments? Is it making your life harder, or on the contrary, maybe there are some opportunities that we need to take right now? Or what are your thoughts?
Yeah, I think choices for customers is key, because the thing we should not limit. If we look at the ECB and European regulators, they're very clear that even when we had digital euro, it will not replace cash. Similarly, when we look at payment alternatives, choices the client helps, because competition is good. Notwithstanding I'm saying this, but I do think competition keeps us on our toes. Like fair, accountability outcomes to clients, because clients have choices into what they want to do. I do think the world is going to move towards, you will have stable coins, you will have wholesale CBDC, you will have tokenized deposits, and other forms of payments, because as we speak, these are already happening, right? Because it's not just proof of concept. There are, in certain jurisdictions, some of the things I described are already live, right? So we are a minting and burning bank of stablecoins. So we know how stablecoin works, because we integrate in our payment system right now, both traditional as well as a real-time payment. So, but like I explained, in order to do it at scale, we need everybody, right, from the fintech firms to the regulators to the FMIs to the CCP, to work together to adopt the same standards, same classification, so that we lower the bar of frictions that's happening around us. So until that is addressed, we will still see some friction. But my point is, choices are good for competitors. There are different use cases for different payment alternatives.
I can certainly agree with your punchline, like choice is good. Choice is good. What I want to add is this opposition between CBDC and stablecoin in a way is artificial, because if we look at how things work today, I mean, when we as individuals buy shares, none of us ever have access to central bank money. We have access to commercial bank money, or we have access to stablecoins, right? And therefore, already today, you have a two-tier settlement system where within the books of the CSDs, you have sometimes central bank money, but then the customers, retail customers, asset managers, pension funds, etc., never access the central bank money, they access commercial bank money. So I think we need to be prepared to have the same type of mechanism in the future, where you will have a coexistence of central bank money for some part of the settlement activity, and stable coins, tokenized deposits, whatever, for other parts of the settlement activity.
Isabel, do you think your clients are ready for it? Is the market ready for this kind of revolution that is already there?
Yes, and then I will probably also answer to this dilemma question. But first, maybe to give you some figures, we have more than 40 participants on Pythagore, and I don't mention the other initiative that we have on our platform, the FMI Plus, but only on Pythagore, we have around 40 market players, 16 issuers, meaning probably half of the short-term CP market, working all together. So maybe one sentence to say that imagine the effort and the cost it represents for the full ecosystem to go and, let's say, transition or migrate to DLT. as one body. I mean, that's a superb effort. So it means that not only they are ready to go for 24/7, ready to go for atomic settlement, ready to go for CBDC settlement first, and ultimately stablecoins for other instruments. But it means what? It means that market participants are ready to question their business model. Because what's the point of replicating the current ways of working? Replicating the workflows that we have today with all their frictions, and just imagining that with DLT it's going to be a bit better is not enough if you think twice of the effort and the cost that it represents for the entire market. And it's not only France, it's France and beyond. We have the major banks in France, and I cannot cite all of them, but at least to mention that cross-border, we have JP Morgan, ING, Rabobank, a few, the EIB as well, a few international players that want to come and play or participate because it's going to be something at scale. And again, the readiness is not the readiness to settle against CBDC. It's the readiness to question their own workflows, ways of working, and philosophy. And I think it's very important to understand, I mean, my colleagues all said it, it's there. People are ready to find solutions, and the solutions are not probably to answer to the dilemma CBDC against stablecoins. Both have a use in different cases. You know, interbanking is about credit risk-free, how to say, peg risk-free, and so on. But for smaller players, of course, stablecoins are welcome and will be regulated soon. But to shorten my answer, I think people are really ready to question what has been the paradigm of this industry for decades, and it's an excellent trigger to find the solution missing for netting and other critical problems we have.
Well, I would like to thank you all for this conversation. It was really interesting to take a step back and have this overview. This was, I think, yeah, we couldn't miss this conversation. Thank you for the panelists, and thank you all for your attention.
Thank you.